Hey everybody, Steve Tinkham with Catalyst Lending. I'm bringing you today's Friday rate update, letting you know what's going on with the market. As we know, since November, since the day after the elections, rates have done nothing but go up. We've made a little bit of a comeback, probably not quite halfway back to where we were, but we have made some comebacks. Today was a make or break day for rates, really, and we'll see what happens. It all has to do with the jobs number. The market was expecting 150,000 jobs, sorry, not dollars, 150,000 jobs created. It actually only came out with 113,000. And really the part that's disappointing for them is that they were thinking secretly, kind of behind doors, that the number was going to be well above 200,000. And that has to do with Wednesday's number that came out from ADP that said that over 260,000 jobs were created. At the time, people were kind of questioning that report because it hasn't been all too reliable. And today's report really confirmed that number was way out of base. So I don't know. This morning, the bond market has opened up, and that's good because if the bond market goes up, that means rates come down. But it's really not doing a whole lot. It's opened up a little bit, but we're at a crucial time here to where it's got to make a leap forward and go up quite a bit here. Otherwise, we stand a risk of the bond market falling back down to where it was, which is quite a bit lower, and that means rates will go up again. We'll have to watch this, but we really need the bond market to make a surge between today and probably the next couple of days next week. Otherwise, we may be in a tough position. As of this morning, where we're at, on a 30-year fixed conventional loan, we're at 4.875%. On a 15-year fixed, we're at 4.25%. If you've got somebody that's looking for an ARM, don't know who that'd be, but if you got somebody, we're at 3.625%. And FHA, which is pretty much all everybody books anymore, is at 4.75 on a 30-year and 4.25 on a 15-year. Now, let's be realistic here. Even though those rates are up from where they were, they're still really good. We need to make sure that we get people off the fence. Now is the time to get in and buy before house prices start going up. At some point in time, there's going to be a recovery. I think we've bottomed out in a lot of areas, and it's time to actually start making something happen. An interesting number was presented to me a couple weeks ago that I just can't get out of my head, and that was, on average, over the past 8 years, until recently here in the past couple of years, but the years prior to the past couple of years, people bought 1.5 million houses per month. There was 1.5 million transactions per month. In the past couple of years, there's only been about 300,000 transactions, and that's across the whole United States. So that means, just based on historical averages, we've got a whole glut of people that haven't done a whole lot over the past couple of years. So at some point in time, when this turns around, there's a lot of people that need to enter the housing market or move up, to get that other house. So there's going to be some action at some point in time. This thing will break open, and then we'll be in a situation where people wish that they would have taken advantage of these low rates, because as soon as all that starts happening, rates are really going to start ticking up, because that's going to be an inflationary alarm. It really is. So that's what we got for today. Hopefully everybody has a great weekend. Please remember to subscribe to this blog so you can get this update automatically, so I don't have to send the email. It just automatically comes to you, and you won't miss out, because we're also doing weekly discounts to some great offers. And I'm sending out some funny videos, so you might like them. So go ahead, subscribe, and please forward this on to anybody that you know that may find this information helpful, and have a great weekend. And go Chiefs! Beat the Ravens on Sunday.